From the morning reading, sellers take control again late Friday, sending the SPX lower for the third straight session. The VIX hits a 27. All 9 sectors moved lower on Friday. XLU, XLP, and XLK were the strongest sectors, while XLF was the weakest sector. Breadth strengthened as decliners led advancers 2.19 to 1 on the New York Stock Exchange and 2.45 to 1 on the NASDAQ. Last week was, from the media's perspective, the worst start to a new year since the New York Stock Exchange was created. A lot is being made of that in the media, but let's keep the decline in perspective. It was a terrible week for the stock markets, but there have been many weeks that have been far worse. It was the worst start to a new year. Historically, both the Santa Claus rally and the first 5 days of January are often indicative of how the year will be. For 2015, the Santa Claus rally should have started December the 29th, 2014, but instead it turned out to be the market top at 2093.55. The first 5 trading days of January 2015 were down, then up to end basically neutral. These two events should have signaled a poor year for stocks, and indeed 2015 was poor. This year, there's been no Santa Claus rally again, and now the first 5 trading days of the new year have been negative. Historically speaking, 2016 is not giving a lot of confidence. I think it's also interesting that the present decline is that this happened within a few weeks of the Federal Reserve raising interest rates for the first time since the zero interest rate policy was put into effect in 2008. The rate hike in December has come at a time when much of the global community is experiencing feeble economic growth, oil is collapsing, many commodities prices are collapsing, including base metals, and the larger derivative markets and so-called junk bond markets are in turmoil. Since the sell-off in late August, the VIX index has rarely returned to below 13. 13 and below are far more average than 15 and above. Looking at the VIX chart since July, you can see the turmoil within the stock market as Friday, January 8th is showing signs that may well challenge the late September retest of the August lows of 1870 on the S&P. It is easy to see that the decline is not quite over yet. There's no obvious price support, and the internal condition is not so oversold that prices can't go lower. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:19 a.m. Central Time, and I'm recording this in preparation for the market day of January the 11th, 2016. Remember that on the YouTube video, you can have free subscription to the channel and be alerted to new content being published. Give the video a few minutes after being published for the video to be available in high definition. Click on the setting button to choose the high definition playback level. In this same area, you can also control the speed of the playback. I routinely find that I can fully understand videos at about 1.5 times the recorded speed. Full disclaimers at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So we had quite a bit of morning reading there today, and that's pretty typical when we have really important times in the market, and I think it's fair to say that right now is a very important time in the market. Let's go ahead and bounce over to the morning report, and on our 4 broad market U.S. indices, right now they are positive, and in the overnight they were kind of all over the place. At times they were pretty significantly negative, not significant compared perhaps to the last 2 weeks, but they were down pretty weak, like 10 points and so forth. Right now they are up, and the S&P futures are up about 8 points, or about 0.4%. The Russell futures up about 1/3%, as are the NASDAQ futures. The Dow futures are up just below 1/3%. Crude oil down big, down 1.81%. Euro essentially scratch. Bonds down about 1/4%, and gold up over 0.5%. In overseas action, China down big, down 5.3%. Hong Kong down also big, 2.76%. Japan noticed that the market is not showing a quote for the 11th, so it appears that Japan is closed. In Germany, up about 2/3%. In United Kingdom, essentially scratched. So very, very mixed action. And most of the time in recent trading, when China's been down big, the rest of these key markets have also been down big, so pretty interesting divergence going on there. In terms of current macroeconomic reports for the United States, today there is no significant events. In terms of tomorrow, we have an FOMC member Fisher speaking, and we have the JOLTS job openings for the only significant events of the first 2 days of this week. In terms of current volatility and market conditions, a couple things to kind of keep in mind here. Short-term VIX definitely way up, almost to 28. We have skew also quite elevated at a 135 plus. And you see the IV percentiles have certainly been climbing the last 2 weeks. While these are not high numbers by any relative sense, they are way up from where they were. The S&P at a 52, Russell at 50, NASDAQ 52, and Dow at a 57. In terms of standard deviation moves, we've also been tracking this with great interest in recent trading and are running quite a few standard deviation moves in the last 2 weeks. Looks to be 6 out of 10, which is still well up over the normal being about 4 single standard deviation moves in a 2-week period. We have seen this as high as about 8 out of 10 sessions, so we continue to be quite dramatic in our price moves, though on Friday only one actually had a 1 standard deviation move, and that was on the Russell. In terms of the charts, let's go there. And this is about as dramatic as we could have. It reminds us back of the August breakdown, in which let's zoom in a little bit here. 1, 2, 3, 4, 5 trading sessions. We dropped, I think it was something like 250 points. I won't spend the time on that today. So far, we're down, I think, about 150 points in this most recent move. So not as dramatic as August, but still pretty significant, especially since this one is coming from a little relatively lower, and we've hardly had an uptick during a time of the year in which it's normally bullish. So very, very ugly action. 1, 2, 3, 4, 5, 6, 7 trading sessions, only one with a positive day. And in those 7 trading sessions, we've often even had gaps down and then followed by large bodies. And really, really important, we have broken through several very significant horizontal support areas. When we broke through this area, that was very important, and we just went right through it. We went through the key fib retracement without even a pause, hardly, and we're kind of down here in an area where there's no obvious support left until you get to the August lows. And so we're now looking at this 1870 area. Now, we could obviously bounce in here, but the primary theory is that we're going to probably go to 1870 at some point before we find any kind of significant real bounce to this. That's something other than just another bear flag and then legging down as people reload for the next bear leg down. 1870 area is going to be absolutely essential. If that does not hold, this becomes something far, far more significant. We have already come in some of the markets to correction territory. On the S&P, I believe it's about 9.5% between the highs of early November and the lows of the current move. So this is already a pretty significant move in near correction. Having almost 1,000 trading days without a correction, and then going into August, and then some 4.5 months later, looking at another correction is quite a turn of events. So kind of keep all that in mind. In terms of the Dow, very much the same ugliness, and really only the August September lows are, you know, anywhere nearby to provide an obvious level of horizontal support. NASDAQ has a little bit stronger in relative terms, so there's a little more distance, but again, no obvious support in this area until we get down to this 40-50 area. And then the Russell total breakdown. Remember, the Russell was the one that broke its August low and set a new low at the end of September. So it undercut the prior low, and now it is blown through that low. So this is far uglier, and the Russell is out here really looking at having already tested the area of the prior October low of 2014. And after that, you see, it just becomes a matter of exhaustion. I mean, none of this really stands out to me. And we start looking at multi-year lows and so forth. It's more of a pattern of probably other markets coming into exhaustion. Once we get past this, we'll call it 1040 area on the Russell, on the RUT, you know, it's basically in open air. So just looking for exhaustion at that point. In terms of the daily report, let's go ahead and go there. And this is, you know, amongst the more ugly reports we've seen in well over a year. We are phase 5, the break of horizontal diagonal support. Market portfolio investor posture systems, IBD status is market in correction. Accumulation distribution score in the S&P is a very ugly E. NASDAQ also that same E. GMI index is a worst case 0 out of 6. That sell signal's been in place since 1210, and that author is very happily 100% in cash. Decision point scoreboards continues to become very, very ugly, and you see the short term is almost universally ugly and bleeding over into quite a bit of the intermediate term. Long term was already mixed signals. This can get uglier for sure, but in terms of short to intermediate term, which is primarily where an awful lot of our trades are initiated, these are all pretty ugly. Intermediate term market posture, very bearish, plus a bearish sentiment line. So we expect the bearish moves to be longer and more pronounced than the bullish moves. Inside the position sizing opinions, portfolio at a 0% and volatility at a 50%. So both of those getting to be quite low. And you see if we get much higher on the volatility to go over a 30, that would go to 0 as well. Intermediate term market posture, very bearish but it does have multiple bullish clusters present. We are starting to see signs of exhaustion and other potential reversal setup triggers. We have not yet seen anything to say that the bottom is in or exhaustion or flushing patterns are developing. It's just that we've gone so far, we're starting to see some very, very oversold readings, and other things are starting to come in and say that reversal is probably in the short-term future. That being said, is it just a kind of a bounce and then back over? So in terms of a real bottom, got to watch the signs, but right now we're not seeing anything to say that a real bottom is in. In terms of those individual markets, you see these are very ugly numbers: 11.4, 10.9, 8, 4.6, all in the severely bearish camp. Remember, it can stay severely bearish for a pronounced period of time. When you talk about oscillator systems, you can stay overbought and oversold for extended periods. Hedge warning status is at its highest risk level, level 3, which is crash warning. It is the potential for a significant market breakdown. It's not a prediction that we're going to have something much more serious than the current near correction, or a prediction of how far we might go, but it is saying in its opinion that the hedge warning status is a high probability for significant risk to the market, and you should behave with your initiation and management of your current positions as such. In terms of individual metrics, You see from the volatility basket, market in decline, sharp increase warning, VIX futures up over 18. Obviously, distribution day count very high with market in correction. VIX phase has been increasing. The VIX ratio warning is fired. We're now looking for market reversal setups from that setup. And then also, of course, skews high. Current week out expected move on the SPX. Let me double check that one. That's a couple days old, and obviously with the current action, that one's now up to a 72. So keep that in mind. In terms of the New York Stock Exchange new highs, new lows, anything over 300 is a warning, and we're over 3 times that at well over 1,000 new lows that were set on Friday. In terms of the key intermarket risk aversion indicators, and these are key ratios that I watch to see whether we are considered risk on or risk off. 4 of the 5 are currently flagging as risk off. Fear and greed index is continuing to drop. It's now down to an 18. We're heading into that extreme fear category. And then finally, let's wrap up with our special opinions and sector specific. In terms of special opinions, option income strategies, cover call strategies, put selling, in all 3 baskets, the current opinion is that we are outside the acceptable windows to initiate new positions for novice traders. Aggressive traders may want to take advantage of these kinds of moves, knowing that you must have the ability to be very flexible and be able to account for very large delta and vega moves to your positions. Clearly not the environment that's conducive to novice traders. In terms of sector specific, you see it's a sea of red. Utilities holding up the best, but still also as a defensive sector, as is consumer staples, showing some signs of still stability. This is not saying much for the market's health. In terms of percent change, even utilities slightly negative. And keep that in mind, this is not necessarily the time to buy utilities if you're not already in utilities. Utilities are a defensive position, as are consumer staples. But you see, like consumer staples is down, heading towards 1% just on Friday, and for the 5-day was down 2.93%. Of course, that's far better than being down 6 or 7%, but just because they're defensive doesn't mean they don't fall. In terms of the relative rotation graph, it's about as ugly as it gets, with only the semiconductor index in the upper right-hand section. So keep that in mind. This is if you are a bull, you're having to find very little to support your argument at this time, and really almost any time frame, short, intermediate, or long term, very difficult for the bull to make the case. Now, what you can make the case for is that you can be developing your watch list, looking for those signs of bottoming. Those that fall the hardest often are the first to reverse, and you'll start watching for those high yield bonds, the commodities. These other places that have been so beaten up will likely find their bottoms, find their support, find their value propositions, and start to turn first. So watch for those areas, see those turns, have your watch list ready, have that list of stocks that you've been wanting to get into, and now you have an opportunity to buy at that discount. Have those lists ready to go, and then we'll start, as we see signs of a bottom, to look for opportunities to start, putting on some put sell positions and bull puts and other strategies that can be starting to layer in once a bottoming pattern starts to show its indications. But as it stands right now, this is just about as ugly as it gets, and it's about your managing your hedges and about managing your current positions, and not about the initiation of new positions, in all likelihood for the vast majority of retail traders. That's enough for today. Big day. As always, if you find this is useful to your trading, go to YouTube, subscribe to that. It's free. That'll give you notice when content is published. You can like on YouTube. You can retweet on Twitter to your Twitter followers, to your StockTwit followers. Other comments can go to support@falconglobaltraders.com. And I'm scrolling over the special opportunities that are present right now. If you need more time on those, you want to take a bigger look, just go back and in the video and freeze. But support at falconglobaltraders.com is the email address if you've got comments that you'd like to send direct. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And if you'd like to see the full legal disclosures, go to this hyperlink right here and you'll have pages of stuff to look through. That's enough for today. We greatly appreciate you listening, and we'll see you back here tomorrow morning from the Falcon Global Market Preview. Good trading, and manage those positions with the knowledge of the current market conditions and the current risk levels each and every trading day.